This is an overnight swing trading lesson that I've had to learn over time, and I'm going to share it with you to make you a better overnight swing trader. This is about gamma regime, which is positive or negative, and it's really how the dealers are positioning themselves. Are they more proactive? Are they reactive? And we don't have to really get into that. Gamma itself is really a measurement of the speed of the delta move. Again, you don't need to know all that either, but you should know if it's positive or negative, because that can determine how aggressive or the approach to your overnight swing trade. You may have noticed during the summer of 2025 into the fall, we were just ticking up. The market was just going up day after day after day. That was a positive gamma regime most of the time. There were some negative periods, but they were very short-lived. Most of that was very positive. And that is the characteristic of those positive, long positive gamma regimes, where day after day, the market tends to go up. It may start down a little bit, but then it goes up and it keeps going up. Not huge moves, but it's pretty reliable. And we have to be aware of that when we're overnight swing trading, because we don't necessarily want to hedge ourselves, because traditionally the moves are not big enough to really cover those hedges. However, in a negative gamma environment, well, that's when we see those really big moves, and hedging isn't a bad idea. When we talk about our 2-to-1, 3-to-1 options ratios, often based off of delta, like a 50 delta call and a negative 25 or negative 15.15 put, as a hedge to protect ourselves in case the market swings the other direction. And in a negative gamma environment, quite often the move can be big enough that we can make money even if our indicator is wrong. So what I'm saying is, knowing which environment you are in can really help you determine how aggressive or conservative you want to be in your overnight swing trade. For those of you who are new, we are overnight swing traders. What we do is we buy at the end of the trading day and we sell in the morning. In other words, we're going after the overnight gap. Rather than a bunch of small moves during the day, we're going after a bigger move. And that bigger move is sometimes hedged to protect ourselves. But as we're talking today, we're talking about what environment we're in. And there are times it's just better to make a small position size decision, a aggressive position size or a small conservative position size, because if we're in a positive gamma environment, the moves may not be as big, but we can still use our indicators to decide again how aggressive or conservative we wish to be. But when we're in this negative gamma environment, we may want to go all out, because these are the times where this system really shines. This is where we tend to make most of our money. And quite honestly, this system was developed during a highly negative gamma time, and so we had to learn the hard way as we developed our overnight swing trading system. At the very end of the trading day, we go to spytomorrow.com and we see the up or down signal, which is free and available to everyone. However, we do have dashboards available, and on those dashboards we do have, as you can see, the G switch. The gamma environment switch is positive. And to give you an example of what it kind of looks like, we can see that, hey, the overall average volatility is low, and the ratios and even the market gap pressure is low, kind of indicating that we're not going to have a big move. Everything is pointing up and the pressure is on our side, but it's going to probably be kind of a flat move the next day, and that's exactly what happened. As I'm recording this, we started up in the morning and then it went down, and we're down a little bit, then up and down, but we're staying near the flat line. And we had a good sense that this is exactly what might happen, especially if there's no real news being released after the bell or in the morning. Nobody really positioned themselves to protect themselves overnight in a big way, because, hey, it looks like there's nothing big going to be announced, and we ended up, as expected, with a relatively flat market. So overnight, I went for a little more volatile QQQ trade, but just directional up. I didn't make a lot. It did open up higher, but then it went down and then up, down most of the day for much of the market. However, if we had put in a hedge, we most certainly probably would have lost. I could have put in, say, a 50 delta or a 2-to-1 options ratio. Sometimes you can buy 2 calls to 1 put, or you can buy, based on the money, maybe a call for $2 and a put for $1, or again, based off of delta, which is what I like to do because it's a little more of an exact science. But the thing is, if I had bought that hedge because it was such a flat market, I just would have lost altogether. However, if we were in a more negative gamma regime, we'd probably find that volatility is higher because the dealers are doing more chasing than anything, and we're just trying to right the ship. And it tends to be that negative gamma regimes, just like high volatility, isn't as common as the positive. Let's say maybe over a year you're going to have 60-70% positive gamma days versus negative gamma days. So when they do come around, this is the time to pounce. But again, you want to protect yourself because it is a crazy market. And if there's big news that turned it all negative, well, chances are it wouldn't take much for it to fly the other direction with a little bit of positive news after the negative news. It's important to consider. And there's also something to consider, and that is the IV crush. So if the market has been negative for a while and we've been making money with big moves in this negative regime gamma environment, wow, things are going great, but then all of a sudden now it's positive. Well, that's the time where we start to see those IV crushes, because as volatility increases, so do the premiums of our options, and you'll see them inflate more and more and more. And then when it turns positive, well, then they deflate. And even if your indicator is right, you could still lose money overnight, especially if you're hedged because of the deflation of your premiums. And we just don't want to see that, so we want to keep an eye. When we see that flip from positive, or actually negative to positive, that may be a time to be careful, maybe take a step back, or just have a very small directional position size. For many of us, we just want to know either up or down. And again, that's available for free on the front page of SPY Tomorrow. And if you're kind of curious as to how you might want to keep track of everything to maybe determine if you're in a negative or positive gamma regime environment, look, if the market is slowly ticking up, it's probably positive, but keep an eye on those IV numbers, on the volatility. And if you notice that those numbers are going up fast, you're probably in a negative environment. And it may be a good opportunity to hedge and protect yourself. Although volatility is the name of the game for options overnight swing traders, not all overnight swing traders use options, and sometimes it's a combination. In a negative gamma regime, we'll use options because we have a great opportunity to make a lot of money. But again, during those positive times, options may not be as strong. So maybe you just buy stock and hold on to it during that positive time, or maybe a leveraged ETF over that time. And then when you start to notice that the negative gamma is starting to creep up or come around a little more often, then maybe go back to options. There are a lot of ways to approach this, but knowing what environment you're in is going to really give you the advantage. If you have more questions about gamma environments, or have something to add, or just are curious about overnight swing trading, put your questions in the comments below, and I'll see you in the next video.